Good morning. I'm Jenny Ray LaRue. I'm here with my colleague Namaan, and we are market outsiders. We're excited to kick off today with an exciting episode. And it is Tuesday. Nope, no, it's not, Namaan. Naman, you should never let me say what day it is of the week because even if I wake up knowing, by the time we get to the pod, I'm not even sure anymore. So it is Wednesday, July 16th, and I know that because I can track backwards from the middle of birthday week next week. My birthday's on Thursday, my son's birthday's on Tuesday, and birthday week has this one magical day in the middle, which will be July 23rd. So, Naman, how are you doing this morning?
I'm doing well. I've been on the road, but I'm back home. I'm excited for it, and I'm excited to dive into our episode today because I know we're breaking down a business that, let's be frank, neither of us really likes to talk about because there's a lot of different pieces. But I think it's going to be interesting for people to see how we start to peel the layers of the onion back.
That's awesome. Well, I'll kick off if that's good with you, and I'll kind of go through the article that I read that led to the conversation today, and then let's make sure we add something more than just the news. How's that sound to you, Naman?
Let's do it.
So here's the headline: Goldman Sachs profits jump 22% on investment banking revival. Let me tell you two to three things that you could think based on that headline that I think are important for us to tease out because it tests whether we actually understand this industry or not. And I'm not necessarily going to even claim to understand it, but I am interested when I read something to advance my understanding if I'm not at a mature level for that. The profits jumping 22%, one of the most common misconceptions that I see when people are doing case interviews or thinking about businesses in general, is that they think about profits jumping and they immediately assume it's revenue jumping, right? Let's talk about whether that's true or false in just a second for banks. Second of all, profits jumping 22% on investment banking revival could mean that investment banking drove 22% of the profit jump, right? So the whole
They
jump,
could not.
100% was that number from investment banking and everything else, or more, right? But everything else would be down. So the mix of where that money came from is going to be super important for us to understand. And the third thing that you could assume is that investment banking is the largest piece of their business because of a headline like this. Also, it would make sense if you thought that because many of us that went through a consulting and a banking process at the same time knew that Goldman Sachs is one of the gold standard banks, and they recruit mostly into their investment banking group from the same kind of programs where people go into McKinsey, Bain, BCG, et cetera. And so those are three things that I think could be misconceptions that if you start with that analysis or if you never go beyond the headline, you might not actually understand what's going on inside the banking industry. But I actually think that what's happening at Goldman is very interesting at large. I also think that in the future we should suit up and celebrate Banking Week because JPMorgan and Citibank both they reported earnings yesterday as well. So this is kind of we have Home Depot Day. Like we should go into it, Naman. What do you think about this on the surface before we dive into the details?
Well, a lot of what you said, which is um, investment banking probably drove some of that profit jump, but not all of it. I'm also dubious about the return of deal making. What I would want to know is that because the volume of deals that are being made are going up, or is that because the fees that are generated by deals are going? Because you could actually have fewer deals and higher fees, because it just means that the deals are worth more. And so that would be the fourth element that I would add to this is just the return of deal making could also mean different things, and you would extrapolate different things about the broader economy based on what the return of deal making actually means. And so I'm excited to dive in so we can figure some of this out.
Awesome. Well, I'm going to go through a Financial Times article, and then I know you pulled up a Wall Street Journal article. I don't think you've even looked at it really in depth, but we can look at that together here on the call. But here's kind of below the tag, right? Profits at Goldman Sachs rose more than a fifth in the second quarter. I don't know why they like just made you do extra math there. So
That's how you know
the
the
Financial
Financial
Times.
Times is British.
Seriously, as a surprise rally in investment banking added to a record period for the US banks equity traders. So then you kind of have to dig in here, right? Comfortably beat estimates. That's something that we talk about a lot here, is that a lot of the news that gets reported
All
is not when somebody is up but when somebody is up more than you expected them to be. What were you going to say, Naman?
Well, I was just going to say it's a little bit of it's confusing language here too, because, you know, if you don't understand how the business works, you wouldn't understand like why they're conflating IB and equity traders. Like those are two separate divisions inside of Goldman. And so what they're saying is you had a record period for the trading division plus a rally in investment banking. And
Totally.
if you don't understand the business, then I think that sentence could be confusing as well.
Agreed. And so, right, 4.3 billion in revenues, in equities, but then also, and you'll see here, which I think we would have expected and we predicted in our earlier banking segments this year, is that volatility in the market creates opportunity for arbitrage that wouldn't be there
Yes.
anywhere. Banks wait for and price models for opportunities for those kinds of arbitrage situations. And I would say that Liberation Day is probably one of the greatest arbitrage opportunities in the
Opportunities.
last decade, right? Um,
Let's
in
just say
fact,
quickly too.
oh yeah, go
No,
ahead.
no, I was just going to say it's the smallest division at Goldman, but one of the highest margin. And so that's why you're seeing that play an outsized role in contributing to this 22% profit bump. Like 4.3 billion, that's a small amount of money for Goldman, but it's almost entirely margin. And so that's why you're seeing kind of this big profit jump.
It's good. That's actually one of the key insights that I have is that a 22% profit jump is largely in banking tied to that similar scale of a revenue jump. So you could get that in other businesses by driving costs down. In fact, earlier this week, or I think maybe last week, we talked about AI in banking, right? So we talked about the drive down of costs on the fixed side of the business inside banking, but like one AI coder doesn't do it in banking. It has to be like basically the removal of an entire division that makes a material change in your profitability. So, for a lot of banks, they have revenue, which can come in different ways, but depending on the mix of the type of banking that they do, in many situations, a lot of that, just like the fees for investment banking, fall almost entirely to the bottom line. So you have these, pretty high margin segments of the business, largely because of the way that they're designed in the first place, which is different than making cars or making, flying planes, right? These are different kinds of businesses. And if you don't understand that, this is one of the businesses where a 22% jump in profit is probably not cost driven. It's almost definitely revenue driven. So there is a line that you can draw there, but you have to understand when you should do it and when you shouldn't do it. Otherwise, you kind of risk being out of touch in other segments of the market. Did you want to say anything else about that before I dive into the different lines of business as well?
No, I think that's really
Yeah.
good.
And then I think the fixed income unit, right, narrowly surpassed estimates with 3.5 billion, 2.2 billion in investment banking fees. So here you've got equities trading, you've got fixed income, and you've got 2.2 billion in investment banking fees. And so you're seeing the stack ranking of the business. Investment banking is not the largest part of the business. So again, one
Well,
of the
let me just say, not
yeah,
last quarter.
not last quarter, fair,
Yeah.
but the jump is a jump that put them into a higher position in total in the market. But this 400 million better than analysts had forecast is about a 20%, not quite, but about a 20% boost. And so that 22% profit jump was largely driven by the investment banking sector. Again, not always true. Sometimes you're tying things together that wouldn't be true, but because the dynamics of the investment banking and the investment bank business, not just investment banking, but the types of work that they do, I think that's a fair line to draw here. Um, Naman, where else would you have expected to see something here for JPMorgan, Citigroup? Did you see their numbers, or should we go down a little further?
No, I haven't seen the numbers, and I know that like a big profit driver for Morgan Stanley is their wealth management unit, right? Like it's the part of the business that's least cyclical. And
Mhm.
so one thing I'd be interested in learning is that like something that Goldman does? Is that something that they're investing in? Because that to me is also like an incredibly like steady state, like consistent fee type of business that's high margin. And like in times of market and economic turmoil, like that's the kind of business that I'd be doubling down on top of some of the equities trading that I'd be doing as well.
Well, let's go look at this, right? Every Wall Street bank beats forecasts for investment banking. I think this is pretty interesting. I don't know about you, but I actually would have thought that Goldman would have been above JP Morgan. I've never looked at this before, in terms of the actual estimate, and reported. Each of the banks stayed in largely the same position, with Bank of America being kind of the one outsized performer here. So if you're tracking what's happening in stocks, this is not going to be the entirety of stock performance. This is just the investment banking versus investment banking divisions at each of the organizations. But there are some that you see a bigger delta here, JP Morgan and Goldman, because of their market leadership position. So what does that mean? Like, market leadership matters in this business, right? Which makes sense, right? If you're selling your company or buying a company, then like, who do you want to work with? Do you want to work with number five because their fees are a little cheaper? Or do you want to work with the one that is kind of the seasoned one inside the
Yeah.
business? So there's a scale advantage there, but it's not as material as I actually thought it was. They're not as far ahead as I would have thought they were. And also, this Bank of America number, if I were looking at numbers, I would have pulled that out of this article and said, I want to go look at where B of A is, because their outperformance relative is one of the biggest outperformers, especially amongst this kind of what I would call second tier group, right? Morgan Stanley, B of A, and Citi.
One of the things that we talked about, so we spent an hour breaking down like the banking business, and we'll link to that episode in the description. But one of the things we talked about in that episode is how, at least in the investment banking division, brand is one of your moats because a lot of the work is actually, I mean, it's commoditized. It's not that like it's not that Goldman is going to help take you to market in a different way than JP Morgan would. It's just where do you like feel the most comfort and like where do you have the stronger relationship? And like which kind of brand's prestige kind of shines you up a little bit more. And so I think that's a big part of why companies choose to go with a certain bank over another is just that brand prestige. And you're right, it's JP Morgan, it's Goldman, it's Morgan Stanley is kind of like your McKinsey, Bain, and BCG of this world.
Well, and then I think this to me right under here is the one of the most important pieces of this article. And then after that, Naman, I'd love to move over to your article to see if there's kind of other insights there. But despite the uptick in investment banking fees, these are still contributing meaningfully less in earnings than the bank's trading divisions, which for more than 2 years have been responsible for the lion's share of big US banks' Wall Street revenues. And you see that from before, right? So if you read the headline, you think, wow, investment banking is investment banking, and all these other divisions may be ancillary. They may be like places to park money, but the fee-driven nature of the business is the big issue. Actually, it's the trading divisions that are really
Hmm.
driving that, and that has been a deviation in where the banks are, but it's also recognizing the outsized performance of some of those divisions in a world of AI, of modeling, of arbitrage, and of increased volatility,
Hmm.
politically, socially, socioeconomically, not just nationally politically, but geopolitically as well.
Over the last decade, it's been like consistently the smallest division inside of these big banks. I'd probably say this in fixed income, just because interest rates have been so low. And what you've seen, and we talked about this when we broke down Citibank, is that like one of the divisions I would have been looking to bulk up, expecting market volatility, was the trading division. And so I think that this is cyclical, not structural. And it'll be interesting to see, if and when kind of market volatility smooths out a little bit, if some of these kind of algorithms and machine learning models that these banks are leveraging to be market makers will continue to give them this kind of advantage, or if you're going to see like the revenue contribution of trading go back down. So that's something I'm going to be watching. We won't know that. That's not like a quarter thing. That's like we'll know that in a year or two. But that's something I'm going to be watching from afar.
Yeah, that's interesting. One of the last thing that I just want to say here is that I do actually think here, in Financial Times, the investment banking revival. When you talked earlier about that your kind of skeptical approach to that belief, I don't know what a revival constitutes, but every bank beating estimates is pretty close to probably what that would be, right? But I don't know what these numbers are versus where they were before. We need to look at historicals. I don't know. Also, like you mentioned earlier, there's nothing in here that talks about deal making numbers. or
Yeah.
average size of deal. And that number could be really different at a JPMorgan or a Goldman. They could have done at like 4 to 5 deals, whereas Citi did 20 to get half of the revenue, right?
Hmm.
So like actually understanding that mix would also help you
Exactly.
understand, how the market is
Because
working. And is it just like the only banks that are doing these deals, or I mean the only businesses that are doing these deals are big, right? Because that's not necessarily a revival.
Mhm.
But it definitely doesn't mean it's not a revival, right? If you look at all the way that these beat the estimates, there is
Mhm.
something going on here in the market.
So, yep, this is relative to estimates. So, hey, good for these guys. Like my hypothesis is that you actually have, and this is just based on my own observation of the news. You know, like I'm personally seeing like less IPOs still this year. I'm seeing less M&A activity, although it's picking up from where it was last year. And so, kind of my hypothesis is, oh, okay, we actually have fewer deals. Uh, they're generating more fees from fewer deals. And I think a part of that is because you don't see as many middle market companies come public anymore. Like you have other liquidity and funding mechanisms now. If you're a middle market company, you have private credit. You are able to you're able to pursue kind of other like investment or liquidity avenues that allow you to retain control of your company without being beholden to the public markets. Like we saw, for example, uh, you know, Meta take a stake in Ray-Ban last week. Now, if that parent company wasn't public, like that's a great way to like generate capital without having to go through the IPO process. And you're seeing a lot of private companies do that. And so I think the IPOs that are coming online are by nature bigger because a lot of the middle market companies like have decided that there are other ways that they can pursue that liquidity and the private markets are stepping into that gap. And so I'm seeing like less IPO activity, but the ones that are coming online, Circle, et cetera, are big. And that's my hypothesis for why you're seeing some of these these investment banking fees rise.
I think it'd be really interesting to dive into it. Just one thing to note that I think you're right, but I just want to highlight it's not just the process of the IPO or being beholden to public markets. It's actually being beholden to public regulatory requirements. Right? I think like that's the real big burden on businesses, and certainly in the chatter that I'm talking about, staying private is like holding a percentage of your company is a factor when you think about control, but actually like managing the business, you have a totally different mandate if you're able to manage it in a private market than if you're
100%.
in a public market, right? So there's I see that as well. All right, let's see what the this is Wall Street Journal. Hey,
This is Wall Street Journal. So let's see what they're saying compared to the Financial Times. And we won't repeat the same news
Mom, do you
here.
spend money on the Wall Street Journal? Are you a subscriber?
I am.
All right, let's go. Let's Wall Street Journal, we need you guys to sponsor this pod. This is pretty freaking good.
So,
I'm like, if I were reading this article, there would be paywalls all over the place. So well done, Naman. Well done.
I mean, there's really three places I go to get my business news. It's Wall Street Journal, it's Bloomberg, and it's Financial Times, right? And then kind of everything else is secondary, but those are the big three to me. Um, so let's just see here what's
I don't
going
know if you
on.
get better business news or if you just have to work less for it, but I have to work pretty hard for mine when I'm, you know,
One of the things I
CNBC,
found though,
CNBC free all the way, baby, right?
one of the things I found though is that those three publications will they'll write a lot about the same thing. So if I'm looking for a diversity of business news, then I've got to go to a CNBC. I've got to go to honestly just a Google search
Mhm.
and see what Reuters and the AP are writing about. Because if business news is broken through there, then you know that something's happening.
Yeah.
So like for example, Ferrero acquiring Kellogg that broke through beyond kind of like the business pages of the journal. And so it's one of the reasons like I pay attention to some other publications as well.
That's good. Mm.
Okay, so here, okay, so what you saw in the Financial Times was you saw kind of the big banks and their investment banking revenue relative to expectations. But here, what you're seeing is Morgan Stanley saying, hey, we saw higher revenue from trading, but our investment banking revenue was actually down year over year. And so, okay, great. Higher than expectations is wonderful for the share price, but maybe not as good for like your actual business
That's
performance.
one of our first answers, right? Is
Yeah.
it just that they beat expectations or is it actually
Hmm.
up?
Exactly. So here you've got the news about Goldman now. Okay, about 4 billion in profit last quarter. Okay, so here you go, a little bit more detail. So profit jumped 22%, revenue rose 15%.
Mhm.
So, right, like there's a direct line between kind of your top line growth and that dropping to the bottom line. Um, Look at this. Trading revenue was up 22%, which is exactly the amount that profit was up. So different
Again, right?
insights.
It's not like one business was,
Exactly.
it's not that the business that they're tying it to is the business that was actually driving that 22%. In fact, the investment banking division would have had to have a more than 22% increase because of the smaller portion of the mix in order to actually achieve a top line, or not a top line, but an overall 22% profit increase.
100%. And when I was doing the math on the Financial Times article, I think it came into between 25 and 30% increase in investment banking. So that was so you're right there. This I think is also interesting insight. Trading revenue isn't just uh, the bank taking advantage of arbitrage. It's also lending to institutional clients. So one of the things that hedge funds do is they borrow against kind of their own equities, like to fuel further trades. And so I think that is evidence of like a bullishness in the market. You know, I think you do that when you smell opportunity, and so that's interesting to me that it's actually lending to institutional clients that's contributing to some of that trading revenue. It's not necessarily market making that the bank's doing on its own, and that's something that we didn't see in the Financial Times article. Let's see here. Oh, here we go. Okay, they answered my other question. So the overall number of mergers and acquisitions during the first half of this year are down, but demand for the larger deals that Goldman and its competitors focus on is growing. And so this is what I was wanting to know. Deal making's down 12%, but deal value's up 27%.
That's interesting. Yeah.
And
Mhm.
so that I think gives you some of the insight that you're looking for just in terms of, okay, what's actually happening in the macro environment, and what's
And
the
what would a real
driver of this
revival
increase?
look like, right? A
Exactly.
real revival would be a M&A up and deal value up. Like that's what a real
Hmm.
revival looks like, is that both are growing.
Hmm.
And so only one compensating for the other is like price increases for businesses. Like you can see a bump from them, but they don't sustainably grow a
Hmm.
business over time. Like you have to have volume increase in order to have the durability. So
Hmm.
I wouldn't expect a strategy change inside the organization saying, hey, like we need to hire more people into investment banking. It's just like, fine, we can leave it alone the same way that we would have before. But like you're leaning into tech advances in the other sides of your business. You're leaning into talent in the other sides of your businesses. Like you're leaning into different pieces of your business. So I think that's important to note as well.
Last thing that I'll just mention here, and we write about this in our consulting market report that we publish monthly, is just what's happening in private equity. And I love that they get here, is that like there is a potential driver of demand out there, which is that private equity firms are looking to return capital to shareholders, and they haven't been able to do it consistently for the last 2 years. And so, like, as they continue to feel pressure to do that, like you might see, right, some more deal making activity happen driven by private equity, and that's going to be a boon to the big banks. And so that's something that I'll be paying attention to as we move forward, see if that happens. It's something we've been following in our market outlook reports. We've been saying it's going to happen. We've been saying it's going to happen. Now we're seeing it in the Wall Street Journal as well. So interested to see if before the end of this year we start to see some of that ice thaw.
Look, a lot of investment banking, more than the banks would like, is sentiment driven. And sentiment changing about markets, which, think about the quarters that this covers, right? April, May, and June. There were sentiment shifts, micro and significant directional shifts in sentiment even during that quarter, which is pretty unusual. And it wasn't just all down or all up. It started a little up, then it went way down, then it increased significantly by the end of the quarter. Like if you don't understand that this economy that we live in is not our parents' or our grandparents' economy, then that kind of market sentiment is feels very different than what you would expect. But I think that analysts are going to get better at estimating some of these numbers. I think beating estimates will be harder in the future because they are naturally fairly pessimistic. Most analysts don't want to be too optimistic. So if you have to look at the percentage of the time that somebody beats or misses estimates, beating is more common than missing. But sentiment also changed in pretty radical ways, even from the time that we started this podcast on until now. So I think that's an important driver of this. The other thing that I just want to note as we close is a little bit off the page here. But one of the questions that I had coming out of this conversation was like, of course, you're going to report on the largest banks that are reporting. But I'm actually really curious about what's happening in regional banking at the moment. And the US has a very interesting regional bank model. We have more regional banks than most other nations. We have a highly concentrated top of market, but then a very, very fragmented bottom of market. And part of the regional banking structure, I know a lot more people that are actually operators and owners of regional banks. I don't know if this news is the same for regional banks. I don't know. A lot of them are very credit driven. And so I don't know if the credit markets are still fairly frozen. Like there are other pieces of thinking about the banking industry that I would want to dive into. The last thing that I just want to say is that we rate in our case library when people are thinking about business problems and practicing cases for case interviews. We rate a lot of our financial services cases in the difficult or expert category, and the majority are in the expert category, simply because understanding the financial services sector is very complicated. And so I'd really encourage you, though, to understand it because I interviewed with Goldman without understanding how they made money. I probably went like way too long in my career without just getting some of the blocking and tackling of how does a bank make money. And I think that there are some really important learnings that kind of cascade into every other sector of the business when you understand banking.
So we're going to link in the description to our episode we did recently on breaking down the business models of Citi and JPMorgan, and it's the same business model that Goldman and Morgan Stanley have as well. There's some nuanced differences that we address in that episode, but if you want like an hour-long deep dive into actually how banks make money and strategically what you'd be thinking about if you're in leadership at a bank, then go listen to that episode. I think it's going to be a great companion piece to this kind of analysis of the news. One last thing I'll say, Jenny Ray, is it always surprises me, like you said, like how many regional banks exist in the US compared to when I travel in the rest of the world. Like if my memory serves me right, I think there's like 13 or 14,000 branches of regional banks across the country. It's like 130 regional banks with 13 or 14,000 branches. There's a lot of fragmentation on that end of the market. And so it might be interesting for us to explore that at some point here in the near future.
I think one of the questions that I always go to is like, would I want to buy a bank? Would I want to start a bank? And that the answer would have been a solid yes at an earlier point in the market. I don't know if the answer is still yes. And I think that pursuing that question, is similar for me to thinking about would I want to buy a septic business? Would I want to buy a restaurant, right? Like, what are the pieces of these businesses that, if you think about them from an owner's perspective, make you want to be in them or make you not want to be in them? And how is that changing? Because understanding underneath the hood, it to me is super important. It's really just a reframing of what I want to own the stock, but for me, it's a more active thought exercise, right? So the thought experiment of understanding those is part of the value. Well, we have certainly more that we could add, but we're going to leave you this morning on this Wednesday. It is Wednesday, right, Naman?
I'm
We'll
not so
never
sure
know.
anymore.